Hey, Igor.
Hey, how you doing? Let me just go over this real quick here, and I just want to show you where we are and how we ended up here. So trade ID 3077, if you wanted to go on Discord and kind of get an idea about what's happening here. But what I did was I sold um, a January 31st 90 put, assuming I'm going to get assigned,
Mm-hmm.
which I did. And then I also sold a January 17th 87.95 strangle,
Mm-hmm.
assuming that if I get assigned on this long stock, I'm going to buy more at 87. I already bought shares at 90, which I committed to. I'm also willing to buy more at 87, right? And then if the price between now and January 17th goes higher and I don't get assigned on these 87 puts, I'm going to sell the stock I bought at 90. I'm going to sell it for 95, making about a $5 profit.
Mm-hmm.
So that's the trade plan, or at least, where it started. So now I got assigned 500 shares. Great. Right. I'm keeping track of my cost basis. So my cost basis was 90 minus 55 cents that I collected for the short 90 puts. Puts my cost basis at 89.45. I haven't accounted for the 87.95 credits that I collected, but I will add this, or I will remove this from my cost basis once these two expire, if they are. Right. So I'm not sure what's going to happen there. I haven't touched my cost basis because of this strangle, but I did today sell a 89 call, which is slightly below my cost basis. Right. But I was also able to collect what did I collect? I collected
40 some odd cents, I believe.
I collected 45 cents. So that put my cost basis right at 89. So now what's going to happen is by January 10th, if I get called away at 89, right, I will sell this stock at a break even.
Mm-hmm.
And then I'll just have this strangle, which I don't want to hold naked 95 calls. I will either replace the stock or I will try to squeeze in something before January 17th. Again, close at the money, maybe slightly in the money to get assigned once again.
Yeah. In other words, sell another put somewhere right
Right.
there.
Sell another put, assuming I'm going to get assigned.
Right. Instead of just buying the TLT outright, you're going to sell the put.
Right. So that's the idea. And I believe that there is a dividend coming in the first couple of days of January. So maybe before I get called away on this 89 call, I will be able to catch a dividend, which is probably going to be like something like 30 cents or 35 cents a share.
Yeah. It was 35 and a fraction last month.
Right.
Yeah. It looks like, to me, it looks like kind of a rolling covered strangle.
It is.
And I like it, Igor. I have to tell you, of course, TLT and bonds have been pulverized. They continue to get pulverized. And we're sitting right at some spots they need to be support. If not, we might have a few points of further downside. I believe 82 and a fraction was the swing low from last October, 2023. Um, and I know you're aware of this, but for anyone listening now or in the future, like just watch the size of this trade that you do, and every other trade, because you're doing something you can manage, but size is relevant. And I know,
Yeah.
I heard you say that already in this Zoom session itself. So I kind of like the nature of it. I'm not sure exactly what you're looking for from my comment, but I like the rolling strangle, covered strangle strategy of it. I think it's great to sell the 89 call with this huge overhead resistance that's kind of in place. And you're kind of almost trading it almost to the point where you've gotten your 90 cost basis down to 89. So if you get called away at 89, by my math, I think you're going to make 30 or something cents on it. I can't remember.
Right. If I catch that dividend,
I think it was like 90 or 89 cents, if I remember.
Mm-hmm.
So your actual cost basis on that 90 is just below somewhere in the upper 88 level. So yeah, if you get called away from that, you'll make a tiny profit. And if we continue down, at least you have that call in place and some premium coming in. And I don't know what your ongoing strategy, but it might be rolling that down further over time if, certain levels are pierced or whatever.
Yeah,
Or you might just have it as a set and forget for now, and you're in those, and you'll continue doing I don't know what the ultimate
the
goal
i-
of this wheel campaign is.
the idea for this trade is kind of simple, right? It's the good old boring wheel, so to speak, right? But you also, we talked about this before, where you're going to do a wheel, so you have to number one, consider the underlying. Is this something that you're willing to hold
Mhm.
for the long term? And I'm not here to tell you that 10% of your portfolio should be in bonds and blah.
Right.
This is not a financial advice service, right? So if you don't like bonds, then don't do this trade. If you don't mind holding TLT, then consider doing this trade. I like it because, well, number one, if and we got to check. Different sources have different information, but right now, and this is according to Thinkorswim. Right now, supposedly at 87.09, the yield is 4.84%. So if you buy shares of TLT, and of course that you know the risk is that if this thing goes to 60, this 4.84% yield isn't going to do a thing for you.
Exactly.
But
Mhm.
if you're going to hold shares of TLT and you're okay with the idea that you may be holding this thing for a year or two or five, right? You're going to make at least almost 5% yield just holding on to the shares.
Mhm.
And if you're holding it in a portfolio, and I'm not saying that you should do this in a portfolio margin and utilize the leverage, but you have to understand that 100 shares of the stock at 90 is a $9,000 trade. That's how, if you have the portfolio margin, this 500 shares, which is a $45,000 notional, in a portfolio margin account, it only takes up just under $5,000 of margin.
Mhm.
Right. So if you if you want to use this funny math and, do yield to, PM requirements, it's a pretty attractive trade. Doesn't take up a ton of capital. If you get that, 4.84% yield on whatever money's tied up in this trade, it's not terrible. And then I'm going to try to apply the tactics, selling calls, selling puts, trading around this long stock while I'm holding it,
Mhm.
collecting the yield, as long as we understand our cost basis and we know where we can sell the calls, where it makes sense and where it doesn't,
Right.
we could potentially realize profit in one of several ways. You get the
Yeah.
dividends,
Eh,
you
eh,
get the capital appreciation if you get called away at a profit,
mhm.
and you are selling covered strangles around it, continuously collecting a credit. Um, uh, income source, which will, and if you combine all three over time, you get to work down your cost basis. I mean, I have to believe at some point this trade is going to revert. I don't know when, and I'm willing to hold it for a while. And also, yes, as you mentioned, that there has to be a number. Like you have to understand how much TLT are you willing to hold in your account. Like
Yeah.
you don't want to become the single largest shareholder of TLT because you're so committed um, to this trade, right? So for as long as if you allocate, for example, maybe you say, what, I can hold as much as 5,000 shares of the stock. Okay, so you maybe do 10 tranches of 500 shares at a time. You do tranche one, you do tranche two. Hopefully, you don't get to tranche 10 in 6 months, but over time you can build a position in TLT. And again, this isn't
Yeah.
a high flying pharmaceutical company with.
It's not. And I agree with essentially everything you're saying. It's especially the part where, size is relative to someone's account size and risk tolerance and desire to own fixed income for potentially maybe what might be longer term, because we don't know the dynamic of how far the bond market. It's yielding very nicely right now. Your 4.84 at 87 and a fraction is accurate based on the last month distribution of 0.351 times 12, which is $4.21
Mhm.
fraction cents divided by the 87 produces that 4.84 yield. So I'm with you there. If The thing with TLT is it's an exchange traded fund that holds 20 plus year maturity long bonds. If you look in what's in there, it's usually like 25 to 30-ish year.
Yeah.
So it very much acts like ZB. On some days, it's even more volatile than ZB. Like today, it's actually down a bigger percent than ZB. And I find that happen on occasion. I don't exactly know why. I can't pinpoint it, but my point is these are 2 points. One, it's very long maturity, and you have a lot of interest rate or duration risk, meaning that if rates keep rising, this thing's very susceptible to getting bloodied more. And if we break this 87 or so level, the next kind of support down that I see is about a point and a half, and then down at 82 or so, where the October 2023 low was. If we go down there and break that, well, we're kind of in a new territory for where it might go. What would make that happen? I don't know. I mean, right now the market is super worried about the giant budget deficits, tariffs, the expansionary policies that the new administration might be putting in through deregulation, which are all great on one side, but they don't suppress inflation. They kind of nurture economic growth, which also stokes potential inflation. So I think the Fed is kind of on hold. I think the bond market has come to life and is, I mean, it clearly has. Like this is an example of the big money knows what's going on before the rest of us, because there was some pretty, if you look back at the chart, very aggressive selling from that September FOMC meeting on. And it's been relentless with very few stops on the way down. So, yeah, this thing at the 480 yield is great, but realize what you're holding in there is these longer term treasuries, which are very interest rate sensitive, meaning very inversely related to what interest rates are doing in a very aggressive way. So, and if I'm just going to say if the administration comes in and is successful at doing a lot of what they do, it might cause. I keep hearing we're going to have some short-term pain, and there'll be, prosperity after that. Well, how much is the economy going to grow in 2025? Is the Fed going to have to reverse any cuts and maybe hold steady and or maybe even raise rates a little more? It's very hard to tell, but I think people need to be aware that that potential risk is there, because even the decline we've seen really makes no sense in relation to what's been happening on the shorter term, where inflation currently is, and where the Fed says rates in the short term area are going to go, which should draw down longer term rates. So I hear what you're saying. Okay, 484 is a lot better than the 4.2 I can get in a 1 month T bill, but the risk is just kind of opposite. And but I do think 484 yield on an asset that is probably somewhat depressed over the next few years could be a decent play. Again, like you're saying, none of us have guarantees, but it's a way better buy way out down here at 87 than it's been, in the last 6 or 8 months for sure. And the yield is not horrible, which at some point is going to become competition for stocks. So I think when the administration comes in and there's some clarity on what exactly is going to happen, where prices are going to go, this thing is going to resolve itself one way or the other. So beyond that, I don't know. Watch the size, understand what you're buying here, or exposing yourself to acquire by selling, not you, but anyone, short puts, because I know you understand. And realize that, okay, I'll take this at this strike and I'm going to continue trading around it, which is great. You're bringing income, you're lowering your cost basis, all that good stuff. Just remember or realize it may not be a quick turnaround. Just like if we sell some spy puts with the idea, and I know you do this, you take some assignment on some, you leave your option to roll if you want to. It's kind of like a tranche by basis, I guess. At some point, if you start getting put spy puts, you're going to say enough and it's going to be roll only. But when you accept on those spy puts, you can start selling calls against it, because again, you're effectively almost running a gigantic wheel of sorts. That could essentially turn into a covered strangle like you're proposing here, if that's the desire of it at the time. But if you put those things, and I know it looks like you sell them out and they're, I don't know, 8-10% down, I think, a lot of the time. I'm not positive. I haven't looked at one in the last week or so. if you put that thing and you're already 2% underwater and the market proceeds to have another 15 or 20% correction, that away, under all this, but the TLT is the same thing. We can accept assignment here in the 80s, the mid to upper 80s, but forces may be at play that take this thing to the lower 80s and even into the 70s. So don't oversize it and just be aware of that risk. That's
Yeah. I think that you pretty much nailed it. And just because we think that something should happen doesn't mean that this is what's going to happen. And I think that a lot of people that are when they're looking at bonds, right? They say the word bonds, but bonds they could be anything from 1 month treasuries all the way out to 30-year treasuries, right? And I'm sharing this on my screen, and we had this conversation in our last presentation. You made it pretty clear that the Fed is only essentially controlling the front end of this curve, right? Which is 1 month, maybe 3 month or whatever. And you can see that, right? So here we have two lines. We have the black one and the blue one. The black one is November curve, right? This is what the yield curve looked like back in November. And then you know what? I could actually go back. Let's look at September. Right, let's get rid of November. Since September, we know rates went down. And guess what? You can see that this green, which is the front end of the curve, has fallen. But look at what happened to the 20 and 30.
It shot up. Right.
It shot up. So in September, right, the 20-year treasuries were at 4.19, and now they're 4.9. That's like what? 80 basis points.
It's a lot. In fact,
and that's where TLT lives.
I think these longer term rates have actually risen a percentage point in the same period where the Fed has dropped the Fed funds rate by a percentage point. So it's kind of been almost a 2% swing. But so the green line is a great example of an inverted yield curve. The short end is higher than the longer end. And as you and I have spoken about in a while, like at times, the 2-year and the 10 years, what a lot of people say is inverted or not inverted. And you can look in September and see that it was a little uninverted if you look at the 2-year. But if you look less than 2-year, all those rates are higher than the further out yields. Now, the December curve that you're showing in blue, clearly, except for the 1 year or 6 month to 1 year, the rest of them are trending higher until you get out to 20 years, and then 30 years a little lower. As I've mentioned here and elsewhere, the 20 years typically a little higher than the 30-year. It's a weird dynamic, which I won't get into much here, but it is typically at play. And this thing has uninverted big time on that, and that's what a curve normally looks like. It kind of and you can kind of almost think backwardation and contango for options, but this thing has established itself on a quote healthier look. So if things stay normal, if the Fed continues to cut the 1 month rate, then all those short-term rates should continue to fall, and it should kind of pull down those 3-year out to 30-year rates with it. The shape of this curve, all things equal, in a healthy situation, will stay where it is, and the whole thing will shift down. So if the Fed does come out and cuts a 0.5% next year, and maybe another 0.5% in 2026, the whole blue line could shift to the downside. That's without a resurgence of inflation. That's without a recession in play. If those things come into play, other things will come in for the yield curve, which I'm not going to get into now. I'm already long-winded enough. But this curve we're looking at in December is a normal looking curve. And if it could just stay in the shape of this and move up and down together, I think it would be better for the bond market. But anyway.
Correct me if I'm wrong. And from what I understand, if let's say, now the market is assuming the Fed's going to cut maybe twice next year. We don't know, but the assumption for a 50 basis points all throughout 2025. What if they don't cut? Is there a chance that the shape of the curve remains the way it looks like right now?
Yeah.
But the whole thing will come down, meaning the front month may continue to be firm. I'm not sure, but the the longer end of the curve, right? The 20 and the 30s will come down closer to 4. This I almost want to think that we're at a point where if they don't cut, this will help bring down the 20 and the 30. Maybe the
I
yield.
honestly think that's going to depend on economic strength and what the government does as far as budget deficits and the resulting national debt. If that's perceived as continuing to be out of control, there could be continued pressure on the long end. If the Fed does not cut anymore, and Igor, I'm looking at the Fed tool right now, the CME Group Fed tool.
Mhm.
Right now, the Fed funds is at 4.25, 4.5. There's a 36% chance that, yeah, pull it up and then click on December. Go out to December
This is
10th.
December of 25.
Yep. Okay. You see the 400 to 4.25 at 35.9%.
Yep.
That's the highest probability based on market bets right now. This Fed tool is based on what people are betting on the Fed funds rate and their bond positioning to be. Like, this is not something that aggregates the Fed governors. This is actually what market action says right now. So there's about a 36% chance there'll be just a 0.25% cut.
Right.
And then there's a 30.4% chance there'll be a 0.5% of total cuts down to the 3.75% to 4%, down from the 4.25% to 4.5% level, and just a 13% chance of 3/4. So, as you're implying or suggesting to some extent, the market has wrung out. For a while we had 6 cuts, we had 8 cuts, even projected for this year. Okay, so we ended up with 3. And then next year was at 5 or 6, and it got wrung down to 4. Now you hear 2, but by my eye, it looks like 1, maybe 1.5 cuts. So yeah, if inflation pops up or the economy, even if inflation stays where it is and the economy starts growing again, the Fed really is unlikely to be super aggressive on cutting. They don't need to. They are still a little restrictive at this 4.25 to 4.5 because it is about 1.5% above the inflation rate, which is traditionally fairly restrictive. But as long as the U.S. government is stimulating the economy by whatever means it does, usually by spending or lower taxes or a combination of both. And you and I all of us could debate on what that stimulus has been lately, but we don't need to. I would say both administrations like to spend. The existing one and the new one coming in like to spend. And for years, for decades, our government has not been acting responsibly as far as budget deficits. And it's those annual deficits that lead to our national debt, which is at like 36 trillion right now.
Yep.
So every year the government runs a deficit, it adds that much to the national debt. So that's how that works. And I've also said this for a while, like, I think these rates are safe and these are good unless we're at the time where the market says, okay, enough of this, deficit running, etc., in which case all bets are off. And unfortunately, it looks like we're at that point right now. So that's what's really put a foot on the throat of the bond market, is the uncertainty over how pro-growth the incoming administration will be. And I'm not saying that in a negative way. Growth is great. It's way better than recession. But right now, we don't quite, inflation's throttling it at like kind of a higher multi-decade level than it has been. And any kind of super growthy thing that happens might stoke that again. So who knows? I don't know. You said a few times in this video, you don't know. None of us know. And you know me, Igor, I'm fairly low notional, and I do tend to only sell puts on things that, in a worst case, I'm willing to own and deal with, kind of in a covered strangle way, as you're describing here. But just trader beware. Know what you're trading and understand what's going on here. So again, back to your original thought or question, if the Fed only comes out and doesn't cut any at all, I think the yield curve will stay where it is unless the economy starts slowing down, in which case these longer term rates might start falling off a little. And we could end up in a situation that looked more like September, where the higher rates and are higher than the intermediate and longer term rates. if the market perceives the economy is really slowing down. If the economy does not slow down, the yield curve you just showed in that other picture is a healthy yield curve and is what the yield curve tends to look like that. That's pretty much what the yield curve tends to look like. Sometimes it's steeper than that, and sometimes it's a little more shallow, but that is largely what the yield curve looks like. Yeah, I don't know how far this thing goes back, but you'd probably have to go back into the pre-2008 spot to see what a normal yield curve looks like. I hate to tell you that. Okay.
Right. I mean, it all makes sense, right? The shorter
Yeah.
term interest rates
Yeah.
should be lower than longer
Yes.
term, and that's healthy. When we get
Yes.
inverted yield curve,
Yeah.
short term rates are higher. This is what we know um, by looking at the implied volatility term structure, right? When short term volatility is much higher in IV terms than longer term implied volatility, something is off. So I
Mhm.
think the same applies here. And only time will tell what's going to happen. But I think it is important, and thank you for highlighting the fact that, when people think about bonds, they think, oh, rates are going down, bonds should be going up. Doesn't always work that way, right? It's all about the movement of the 20s and the 30s and whatever's in between. And so far, right, again, I'm going to highlight this one more time. So far, since, or we could maybe even look from the beginning of this year, you can see that the front end of the curve has come down drastically, but the 20s and 30s are up from where they were back in January. And that is the reason why TLT did and does what it does.
Mhm.
But I have to believe that at some point, as you mentioned, a 4.8% yield on an asset that is depressed is going to be a bargain. When that happens, we don't know. So we're kind of going to have to, play by ear, take it, 1 week, 1 month at a time. Hopefully, my plan is pretty clear. I'm willing to take more shares. I'm willing to sell premium around the shares and get called away as long as I keep track of my cost basis, understanding where it makes sense to do covered strangles around the shares. And hopefully, at some point, when we find a bottom, I will have collected enough credits to reduce my cost base is low enough to where I finally get out of the position. Maybe I will be getting out at a healthy realized capital gain. So with that said, thank you, Ed, once again for coming in and sharing your thoughts. Very much appreciated. If you guys have any questions, you can find Ed. He's in our Discord. You can post. He has a channel, a lot of good information. If you are interested in the topic of fixed income, there's a lot of information in the fixed income channel. Please do go check it out. If you have questions, you can ask there.
Yeah, lots of
Whatever
things
I
to
know,
address. Mhm.
I can help you and point you in the right direction to connect you with Ed if you have any follow up questions. So, with all that being said, I want to wish you guys a great weekend. We'll be back next week. Next week's a short week again. We have New Year's coming up, so I don't expect a lot of fireworks. Maybe there's going to be some selling, some last minute tax loss harvesting going on, but we have to worry about only the things that we can control. So if you have any questions, you can reach out to me. You can find Ed in our Discord. Have a good weekend. We'll talk to you guys next week. Bye bye.